So now we talk about the short sale and margin. In this situation, we again have another table. You need to memorize this also a little bit. Based on this, there is what is called a minimum credit balance in the account. So you can practice that. And the way I put it here is you need to remember that there are actually three things here. What is the loan amount? The loan the company gives you is 100% of the value. Whatever the value of the shares is, in the short strategy, you borrow those shares from the company and you sell them in the market. So that is your loan amount, 100% of the value of the market value. So on the day you're going to get the loan, the day you get the shares, you sell them in the market, and that is your loan amount. Now, what this is saying is that if it is $2 and over, 150% is what you need to have of the market value. It means whatever the value is of the investment. If it is 5,000, half of that is $2,500. So you need to have 150% of the market value. So you would need to have 5,000 plus 2,500, $7,500 here in the account. If it is prices between this range, it's $3 per share. Depends, of course, upon the price. And if it is here, you need to have 200%. So then it's 100%. If it's 5,000 worth of the loan, the shares, you need to put in 5,000. So in the account. And same thing here also, in that it depends on the price. And if it is eligible for reduced margin, then it's 130%. So you get 100% of the loan and you have to put in 30%. So instead of 50%, you can put in less margin. That's why it's eligible for reduced margin. Let's take a look at an example. The investor short sells 500 shares of the company at the price of $15. How much margin must the investor put in? So we're going to think $15 is the price. It's 500 shares. So I need to put in some money here. And how much is that? 15 times 500 is going to give you $7,500. $7,500 is the market value. Now, the requirement for this is going to be 130%. Why? Because we can see here, this is eligible for reduced margins. It's going to be 130%. We know it is there because it is given in the question that is eligible for reduced margin. So what is 130% of $7,500? So if you take $7,500 and multiply it by 150 and then press the percentage sign on your calculator, you will get $9,750. So in this case, that is the minimum account balance that needs to be. Yes, that is the minimum account balance that needs to be maintained in the bank account. So that is the minimum account balance. This is more, 30% more than the $7,500, right? Now, what is the loan they got? They actually got 7,500 loan, which is the money from the company, which was 500 into $15. Now, what is the difference? It means the client needs to put in $2,250. This is the requirement for the short sale, that the client needs to put in this amount in order to maintain this margin, right? So this is the purpose of the short selling. Now later on, the shares goes down to $12. See, previously it was $15, it went down. So under short sale, you're going to be happy that it went down. You will make some money. So let's take a look now. If it is $12, we plug it in here, $12 into 500 shares, right? And that is going to be equal to $6,000. $6,000 and then times 130%, that is equal to $7,800. So you need to maintain $7,800. Previously, the day before, when you had a price of $15 and you started out the short sale, you had actually then got $7,500 from the loan amount, and you still have that in the account. So now the difference is actually $300 you need to put in $300 more. $300 is going to be required also, right? Because the shares went down to $12, and so in this case $300. But however, the client has already deposited 2,250, so the account has an excess margin actually. So 2,250 was the amount they put in before. See here, we put in here, we said the client is going to put in 2,250. So day one, the client is put in this amount. The requirement here is $300. So you got extra money available, 2,250 minus 300. So there is $1,950 available. This money may be withdrawn or may can be used to buy more securities, or it's left in the account to cover the margin calls. So this way, if the price goes down in the short sale, you as an investor will have a benefit. But let's suppose the share price actually went up instead of going down. Now you're going to be in trouble. So in this case, the client will receive a margin call. How much is the margin call going to be? So now $18 again, $18 into 500 shares, you will multiply that and calculate what is 130% of it. So 18 times 500 is $9,000. 9,000 times 130% is going to give you $11,700. So this is the minimum account balance you have to maintain based on the price now. And day one, you had got proceeds from short sale. That is 500 times $15. You had got 7,500 as the loan amount from the company. So the difference now is 4,200. You need to have deposited $4,200 in the bank account, in the margin account. You already deposited in day one 2,250. So now what is the difference? The difference is 1950, 1,950. And for this one, a margin call will be issued. The client has to put in this extra amount to fulfill the requirements for the short sale. So hopefully that makes it clear. Let's take a look at the example from the book. In the book, in the CSC, they're saying $5 is the share price, 100 shares. So 5 times 100 equals, of course, 500. And that is your loan amount that you're getting. You're going to take the shares in the day one and sell it in the market, and $500 is deposited to the margin account. So now, what is the minimum credit balance you need to maintain? You need to maintain 150%. So if you look on your table, the price is $5, it's more than $2, it's not eligible for reduced margin, so you need to maintain 150%. So what is 150% of the $500? That is equal to $750. You have to maintain $750. How can you do that when you only got $500 from the sale? So you have to put in, the client has to put in $250. The difference from the minimum credit balance of $750 and the market value of $500, the client has to put in $250. Now, if the price goes down, the client is going to be happy. Now the market value is $400. And 400 times 150% is equal to $600. And the $600 minus the loan amount that you have, the difference between the loan amount, the difference of MCB, the minimum credit balance 600 minus the loan amount of 500, that difference is $100. So it went down. You had put in 250 before. That was what you put in. Now the company is saying we only need to put in $100. So you obviously have extra money available. So 250 minus 100, you have $150 excess. Same thing here. You could also take a look at the loan amount, or sorry, the minimum credit balance. It was 750 and now it's 600 is the requirement. So you have $150 excess. And in the second example, they say it went down more. In this case, the more it goes down, the more beneficial it is. You don't have to deposit anything. But if it goes up, then you're in trouble. So now if it was $5 and it actually went up to $6, in this situation now, you have got to recalculate and deposit more money. So it was $5, and here we said minimum credit balance is going to be 750 that you need to maintain, which is 150% of the 500. And the client had already got a loan of 500. So the difference between the two, 250 needs to be deposited. If the price went up to $6, now 6 times 100, $600 is your market value. And what is 150% of that? It's $900. So $900 what you need to maintain in the account, but you only got $500 from the company. So 900 minus 500, $400 needs to be deposited more amount to the margin account. So the difference here between you got a loan previously yesterday of 250, now you're sorry, you didn't get a loan that amount. Loan is still going to be always 500. You put in 250, now you need to put in 400. So now the margin is higher requirement. There will be a margin call in this case for $150. So this is the example from the book.